security. So valuation of business security is our topic today. So welcome to the class. And nataka nione sawa sawa. So kuna this item hapa. I want to ignore it very. Ile ni sawa inaonekana. Not a must. Now we talk about valuation of business security. We are talking about valuing the business. So we'll be talking about valuing the business. And we shall be talking about some items. So let me see. So we did the IT issue. It's part of this one. So I won't concentrate on that one that much. But now let us start. Let us define what is business. What is the meaning of the word valuation of business security? You can say this is the process of determining the worth of a business. So this is the process of determining the worth of the business. The worth of the business. So this is the process of determining the worth of the business. So this is the process of determining the worth of the business. The worth of the business or the securities or the assets using the information available. Using the information available. Using the information available. Using the information available. Now we can say, so this refers to the process of determining the value of the business. The value attached to the business is called the theoretical value. The value attached to the business. So the value attached to the business to the security. So the security is called the theoretical value. It's called the theoretical value. It's called the theoretical value or the real value or intrinsic value donated by PO. Donated by PO. So we can define it well. Now let us define it with the PO well. So the intrinsic value, let us define it well in a good way. So let us define the PO well. What is the intrinsic value? Now we can say that the intrinsic value, so we can say it's the value of a security refers to the value of a security stroke asset of a company are mostly internally. So within the company, so the value of the company within. But when we are talking about the general market, then we shall be talking about the market price. So the market price. We'll be talking about the market price. But if we are talking about the business itself, or the business itself, then we are talking about the business internally. Now we can also say that intrinsic value equals to the total present value equals the total present value equals the total present value of all the expected future benefits of it refers to equal present value of all future expected benefits of all the future benefits to be realized from the security to be realized from the security to be realized from the security. For example, if you were to determine the value of a share, if it's a share, PO of a share. Now, if we convert future dividends to present value, then we shall get PO. So tunasema equals to the present value of the future benefits, expected benefits realized from their security. Now, if a person invests in a share, then we expect that the other person will get dividend in the future. So that amount of dividend that we get in the future, if we tend to convert those dividends into present value, so those dividends will form the price of the share today. Now, if it is a bond, now we expect interest in the future. So the future payment of interest, if you convert those interest in today's value, we shall get the value of the bond. And therefore, that one we call it the intrinsic value. That one we call it the intrinsic value. Now, we can continue and say intrinsic value forms the basis of determining whether the shares of the company are overvalued, undervalued, or correct valued, or correctly valued, or correctly valued, or correctly valued. So that one is we have said the intrinsic value is the value which is used to determine whether the value of a share is overvalued, or it is undervalued, or it's of correct value. And how do we know that one? By comparing the intrinsic value with the market price, by comparing the intrinsic value with the market price. Now, this is how we compare it. So this is how we compare it. We can say that let me see. So we can say that if the market price is greater than the PO, then the security is said to be overvalued. So if the market price is greater than the intrinsic value, now we can say this one. If, this one is very important, if IV means intrinsic value, which is PO, is greater than the market price, then you can say it is overvalued. Then if intrinsic value is greater than the market price per share, then you can say so it is undervalued. Then ya mwisho, if it is value is the same as MPS, we can say it is correctly valued. So that one is all about it. So if the market price nimefanya makosa, so inafaa kwa if the market price, so let me do away with this one. So let me start with the market price. So if the market price per share is greater than the PO tumesema ni IV, intrinsic value, MPS is less than PO, which is intrinsic value. IV means intrinsic value. Then MPS is equal to PO. Then you can see it is correctly valued. You can say it is correctly valued. Let us take a look. Reason for valuations. Reasons for valuation. So we have about 6, but we have a lot actually. So it's not limited to 6. So reason for valuation. So reasons for valuation. Number 1, all of the reason for liquidation purpose. For liquidation purpose. For liquidation purpose. Now, we usually value our assets so that we know how much are we going to sell our assets during the time of liquidating. During the time of liquidating. So mostly, the asset of the company will be valued when the company is being liquidated in order to determine the amount to realize from the disposal of the assets. So that's number 1. Number 2, in order to use the asset, as a collateral. Now, in this case, now we need to value our assets so that we know how much loan we can take through use of that asset, so that we can take the equivalent amount of loan using the same assets, so that we don't take less loan compared to the assets. So if you want to take the equal amount of loan in comparison to that asset, so collateral. So in order to use an asset as collateral. And also, the bank will require you to value your assets before giving you a loan, so that they know how much worth you want in order to do what? To get the loan. So they will give you the equivalent to the amount of the value of that asset once the valuation is done. Number 3, quotation or listing. to quotation or listing of shares in stock exchange. Now, if a company want to list their shares in the stock exchange, so if a company want to issue their shares in the stock exchange, then what they shall do, they shall value their share and know how much they shall quote within the Nairobi Stock Exchange. So what will be the value of their shares within the stock exchange? So they need to know the value. So by doing valuation, then they can determine. Next, for tax purpose, now that one is Kenya Revenue Authority. The Kenya Revenue Authority will want you to declare the correct amount of information or the value of the business during a particular year for tax purpose. Next, for insurance purpose. For insurance purpose. And what do we have to say for insurance purpose? Now, when you are insuring your assets, so when you are insuring your assets against theft or against anything, then you need to do what? Do the valuation of that asset. Next, for merger and acquisition. For merger and acquisitions. So when one company want to acquire another company, they need to know the value of that company before they purchase that company. So it is good to do the valuation so that we know the value of that company before we purchase that company. I think those are enough. Theories of variation, of valuation, not variation. Theories of valuation. So theories of valuation, we have 3 of them. We have fundamental, technical, and random. Fundamental theory, fundamental theory, and we can say that this theory states that intrinsic value equals to the present value of all the future benefits. All the future benefits realized from the asset or from the security. Let's use the word security. So this theory says that the intrinsic value equals to the present value of all the future benefits realized from the security. Sawa. Now, we can say the future value can be in form of dividends for shares, interest for bond and debentures, and what else can we add? And dividends stroke interest. It can be dividend or interest depending for preference shares. For preference shares. For preference shares. Now, I think that one is enough for now. We don't need so much. But PO for perpetuity, so if I want to find the PO for perpetuity, so it is in perpetuity. So the PO will be given as, it will be given as dividend if it is shares divided by R, or if it is bond, interest divided by R. So depending on the situation, kama ni shares, the dividend. Kama ni loan or debenture, the interest divided by R. You shall get the value of that item. You will get the value of that item. I think that one is fine for now. That one is fine for now. Let's go to technical. Technical or chartist theory. Technical or chartist theory. So technical or chartist theory. So allow me to do away with this one. Sawa. So technical or chartist theory. So we proceed. So technical or chartist theory. So technical or chartist theory, we can say this theory says that the price pattern of the past could repeat itself. So the price pattern of the past could repeat itself. So you can say it is based on history. So this theory is based on belief that history repeats itself. So based on a theory that history repeats itself, therefore, the price pattern, plotted or charted on a graph. Therefore, the price pattern is plotted or charted on a graph to estimate the future price of the security. Price of Price of the security. So that one is fine. It identifies the three patterns. So it identifies three patterns. We note them. So it identifies three patterns. Number A, we have the primary trend. Primary trend. And what is primary trend? Price movement has been observed and plotted for a period of more than 1 year. So price pattern has been observed and plotted for a period of more than 1 year. Of more than 1 year. Number B, we have the secondary trend. Secondary trend. In this case, the price pattern has been observed and plotted for less than a year. So less than a year. So the price pattern has been observed and plotted for a period of less than a year. So it's fine. We have tertiary trend. So can you say about tertiary trend? Price movement has been observed and plotted for a very short period of time. Usually weekly, monthly, or daily. So price movement has been observed and plotted for a very short period of time, i.e. daily, weekly, or monthly basis. That's number 2. That's the technical theory. Let us talk about random walk theory. So random walk theory. So random walk theory. So our next. So random theory. So random walk theory, and you can say it is based on the importance of information. It is based on the importance of information in evaluation of security. So we can say this theory is based on importance of information in evaluation of security. So this theory is based on the importance of information when evaluating security. It is said that security price will be on a random manner. So it states that the price of security will be on a random manner. On a random manner kumaanisha the price is changing from time to time. So it is randomly changing. So in a change. So the price, they say that the price of the security will be on a random manner. It will be on a random manner, depending on the information released in the market. Depending on the information released in the market from time to time. From time to time. From time to time. So depending on the information released in the market from time to time. From time to time. That one is fine. So tunasema to say that the price of the security will be on a random manner depending on the information released in the market. Because of this random behavior, the PO of the security will never be an exact figure. That I need to remember, so I'm not writing that one. So the PO of the market will never be an exact figure because of that randomness of the securities, because of that randomness of the price of the security. Okay. We go to the next part. This theory leads to EMH. So we say the random walk theory. The random walk theory leads to the EMH, efficient market hypothesis. We call it efficient market hypothesis. So the efficient market hypothesis. So the efficient market hypothesis. So the efficient market hypothesis. So what can we say about the efficient market hypothesis? Now, it is said that the information, whether good or bad, once it reaches the market, it quickly reflects the price of the security. The information, whether good or bad, once it reaches the market, it reflects the price of the security. So you can say, state that information, whether good or bad, so states that information, whether good or bad, so information whether good or bad, once revealed the market, once revealed the market, it quickly reflects the price of the security, the price of the securities. Now, a good example of this kind of information is declaration of shares by the company. Declaration of shares by the company. Now, if the company declares that they will pay the shares the next for a suitable future, so if the company declares that they will pay shares in the next for a suitable future, then that one is a good information, and that one might make the value of that share to change in the market. So depending with the information, we list. Depending with the information, we list. Characteristics of this kind of unit. So characteristics of image, features. The features of image. Number one, information whether good or bad affect the price. So that's number one. Information whether good or bad reflects or affects the price. Number two, security price are randomly determined. Security price are randomly determined. Security price are randomly determined. Then transaction costs are minimal. Transaction costs are minimal. Then you can also talk about no investor should obtain more return. Should obtain more return than other investors for obtaining more information. So whether an investor has more information than another investor, the return should be the same. Then abnormal gain. Are illegal. So meaning no one should get more gain than any other person. So if you get more gain than any other person, then that one will be deemed as an illegal practice. That one will be deemed as an illegal practice. Let me see if I have others. There is no speculation in the market. We can also add this one, number 6. No speculation in the market. You can say no speculation in the market. We can also say trading is a continuous process. Trading is a continuous activity. So another feature under the image that trading is a continuous process. So trading is a continuous process. Forms of EMH. Forms of EMH. So forms of EMH, we have the three of them. Weak form, semi-strong, and strong. So forms of EMH. Forms of EMH. So forms of EMH. Forms of EMH. Forms of EMH. They can say we have forms or level or degrees. So you can also call them levels, stroke, degrees. Degrees of EMH, level of EMH, form of EMH. So number one, we have the strong form. Strong form, and you can say occurs when the security price reflects the past, present, and future information about the company. So occurs where the security price reflects both past in the bracket is historical, which is historical. Present, which you can call it published, and future, which you call it confidential. Information about the company. Information about the company. Number two, semi-strong. We can say, so this one reflects historical and the published. So this one reflects the past and present information about the company. So it reflects the past and the present. Then you have the last one, the weak. So weak. So to call a strong, semi-strong. Then you have the weak form. And this one, they only reflect the past information. So they occurs where the security price reflects the past information about the company. It reflects the past information about the company. Reflects the past information about the company. I think that one is okay. I think that one is okay. Now, let's now move to what we were interested. So we do valuation of the debenture and the bond. We do valuation of preference shares and the valuation of ordinary shares. Then we see if we can finish. I think tunaweza jikaza. We do much. Sawa sawa. I think iko sawa now. Let us jump into our we have a good question here. Let's talk about valuation of ordinary share. So valuation of ordinary share. So valuation of ordinary shares. Valuation of ordinary shares. Now, so for the purpose of valuation, it is divided into three. Number A, let's talk about zero dividend. Zero dividend growth rate. Dividend, zero dividend growth rate, ordinary shares. Number B, constant dividend. Constant dividend growth rate. Ordinary shares. Then unconstant. Non-constant dividend growth rate, ordinary share. So non-constant dividend growth rate, ordinary share. We start with the first one. Zero dividend growth rate. Ordinary share. In this case, you can say, so the company promises constant dividend per share. Constant dividends per shares. So the company will be paying a constant, meaning equal dividend per share for each period. So the company promises a constant dividend per share for each period. I.e., you can say dividend for period 1 for period 0 equal to period 1, period 2, up to period n. Now, in this case, ordinary shares are treated as if they are preference shareholder. So in this case, ordinary shareholder are treated as preference shareholders. We can say in this case, ordinary shareholders are treated as preference shareholder. As preference shareholder. Now, the PO, the value of the share, remember it is in perpetuity because it's a constant, it will be there from throughout. Then it will be equal to the dividends we divide by R. Divided by R. So dividend divided by R. In that case, dividend we divide it by R. So dividend divided by R. Now let's go to the next one. Constant dividend. So constant dividend growth model. Constant dividend. Constant dividend. Growth model. So constant dividend. Growth model. And you can say So what can we say? So this is where the dividend will increase at a constant growth rate. So this is where the dividends will increase at a constant growth rate. So this is where the dividend will increase at a constant growth rate until infinity. Until infinity. Now, DPS, dividends will be computed as follows. Dividends will be computed as follows. Now, I know about dividend, the reason why? Because we expect to get dividend from ordinary share. So it will be equal to the dividend of period 1 to be the DO 1 plus G raised to 1. For period 2 to be D1 R not DO plus G raised to 2. Then D3 to be DO 1 plus G raised to 3 up to DN. I can say DO 1 plus G raised to N. Then you can use also Gordon's model. So Gordon's model afterwards. So you can say PO is equals to DO 1 plus G KE minus G. Or call it R, let us use cost of capital. Minus G. Minus G. So before we do Gordon's model, shall we do Gordon's model later? Methods of calculating growth rate. So methods of calculating growth rate. Number one, retention ratio method. So remember, retention, it is the opposite of payout ratio. So when we say 1 minus payout, we get retention ratio. So payout ratio to give us retention ratio. And remember, which is denoted by B. So our growth rate equals to R multiplied by B. So our B is our retention rate. Retention rate. Then our R is return on equity. Return on equity as our R. Method number 2, compounding method. Compounding method. Compounding method. This is the formula: N minus 1 dN over DO minus 1. Then everything multiplied by 100%. Then everything multiplied by 100%. So that one is for discounting. That one is for constant. So let's go to the non-constant growth model. Non-constant growth model. So we talk about constant dividends growth model and constant dividend growth model. How can we say about it? This is where the dividend will increase at a different rate. So this is where the dividend will increase at a different rate. This is where the dividends will increase at a different rates. This is where the dividend will increase at different rates during the early period. During the earlier period. The earlier period of economic life the project before the growth becomes constant until infinity. Before the growth rate becomes constant becomes constant until infinity. Now this one, we also call it discounted dividend model. Discounted dividend model. Discounted dividend model. And in this case, we shall use the constant, not the constant, but rather than we shall consider where the growth rate is either increasing the particular rate, then in a kikuja stable, then afterwards use the dividend model itself. So that we shall use the dividend model itself. Now let us talk about the dividend model. Let us talk about the dividend model, because the dividend model, also called the Gordon's model. So discounted. This one is discounted dividend model. Discounted dividend model. Now, because this model, we shall require the Gordon's model, this one. Let us explain Gordon's model. Gordon's model. And you can say, let us define what is Gordon's model. And we say, this is a method which is used to determine the PO of a stock from the future dividends at a constant growth rate. So this is a method which is used to determine the intrinsic value of a security or shares or stock based on future series of dividends paid in the future at a constant growth rate. Assumptions. Number one, the firm is all equity finance. Now that means that the firm is financed using the shares. So do the issue of shares. Number two, internal rate of return. Internal rate of return is constant. So internal rate of return is assumed to be constant. Is assumed to be constant. Another one, cost of capital is constant. Cost of capital is assumed to be constant also. That's another assumption. That the cost of capital is assumed to be constant. No tax rate, no corporate tax rate. So it assumes that there is no tax in the economy. So under this model, it assumes that there is no tax. Then it also assumes that the firm's streams of earnings is in perpetuity. It is in perpetuity. So meaning, if the firm is getting the dividend, we get a dividend in aina mwisho, we don't know. So the time is not limited, it's in infinity. So the firm will keep on receiving dividend from time to time. Now, retention ratio is constant. So retention ratio is constant, RR. Utilization ratio is constant. Growth rate is also constant. Growth rate is constant. Growth rate is constant. What else can we talk about? What other assumption? I think those are some of the assumptions which we can note. It's constant, and then no external debt financing. No external debt financing. No external debt financing. No external debt financing. And then ya mwisho, transaction cost does not exist. Transaction cost does not exist. So the last one, number 9, you can say transaction cost does not exist. Transaction cost does not exist. The transaction cost does not exist. And this is the formula: PO, DO, 1 plus G over R minus G. DO, these are dividends. G in growth rate, R in the cost of capital, G in growth rate. I think those are enough. So DO is the expected dividend. DO is the expected dividend. September 2021. September 2021. Tunafanya sahizi zote za dividends. September 2021. Question number 1D. September 2021, question number 1D. So September 2021. September 2021, question number 1D. Number 1D. September 2021, question number 1D. So let us try and move to that city. So September 2021, let me see. Gonna say my September. Then you next. Not September, December 2021, not September. December 2021. December 2021. December 2021, where is it? The one which is not pilot. Question number 1. Number 1D. Number 1D, that one is fine. Here. September 2021, number 1D. Let us try that one. So wanasema the following data was taken from financial record of Faraja. We have the EBIT, dividend payout ratio. We have a number of shares, equity capitalization rate, return on equity, corporate tax required. Determine the value, the PO, using the dividend model. Now, let's start with D. How do you find the D? Now, in this case, we need to find the EPS first. EPS is the total earnings. So EBIT, we minus interest, and we also minus tax. We divide the number of shares. In this case, so let us find it. So EBIT in capital, 400,000. Do you have interest? Now, in this case, we don't have interest because this one is an equity. We said that for the Godon's model, we don't have interest. We don't have any other form of finance apart from equity, and therefore interest is 0. And therefore, what about tax? Now, for the purpose of computing EPS, we shall use the tax rate. But in most cases, we are not supposed to use the tax rate. But in this case, let us use it because I've been provided. But for the formula itself, we cannot use it. So what will be the answer? 2.8 per share. So Kenya shillings, 2.8 per share. 2.8 per share. So nasema this one is 400,000. Supposed to be 400,000. Then you confirm 400. Alright, before here, let me look. Oh, then this one is also in 1,000. So 400,000 times 0.7 divided by 100,000, which is 2.8. Can you see 2.8 per share now? But we know payout ratio. Payout ratio is equal to EPS over DPS. So the payout ratio, is it in ratio or percentage? Is it in ratio or percentage? Payout ratio. It is in percent. So come on, in percent, multiplied by 100. So payout ratio is 40%. Is equal to EPS. Tunajua hapo juu 2.8. We want DPS times 100. So meaning our DPS is equal to 40. So DPS is equal to tukitaka DPS itakuwa ni 2.8 over 40 times 100. Ndio itakuwa hivyo. Itakuwa ngapi? So to be the dividend 2.8 divided by 40 times 100. So DPS is 7. Dividends. Ama itakuwa ngapi? What am I doing? Payout ratio formula? Oh, sorry. Nimefanya makosa hapa. DPS over EPS. So DPS. So we want the DPS. EPS ulipata ngapi? 2.8 times 100. So itakuwa ngapi? So calculate for me that one kindly. So much will be the DPS. So it a change. So itakuwa ni 40 times 2.8 over 100. So itakuwa ngapi? So itakuwa ngapi? So 40 times 2.8 divided by 100. 1.12. That's our dividend, 1.12. What else do we need? We need our G growth rate to say B, R retention ratio times our retention ratio. Sorry. For us to get our B, we've got to make our P growth rate. We need the retention ratio. We multiply the return on equity. So this one is return on equity. This one is the retention ratio. So what is our retention ratio here? Now it is 40% payout ratio. What is the remaining? So the remaining is 0.6. So kumbuke inafika 100%. So kama wanalipa 40%, how much are they retaining? 60%. Now 60% is our retention ratio, which is our B, which is our B and B. Then we multiply with the return on equity. So return on equity. Do you have return on equity in this question? Yes. The one which is 12%. Return on investment. So use the return on investment, which is 12%. So 0.6 times 12, which will be equal to 7.2%. So that's the growth rate, 7.2%. Now we can complete our question, our D, our PO. So we have our dividend 1.12, 1 plus G, our G is 0.072. Now our R, if we don't have our R, we use capitalization rate. What's our capitalization rate? Which is 15%. So 0.15 minus 0.07. So what will be the value of that company? So 1.12 into bracket 1 plus 0.072 divided by 0.15 minus 0.072. So our PO is Kenya shillings 15.39 per share. Per share. Let's go to another question. May 2021. May 2021, question 1C. May 2021, question 1C. We go to May 2021, question 1C. May 2021, question 1C. May 2021, question 1C. May 2021, question 1C. So May 2021, question 1C. Yes. Made to know question 1C. So 1C part 1 describe the reason for valuation if Rishapanya. You have the notes. Number B. As a limited expects a dividend of 5.4. The company dividend payout ratio is 16. The company rate of return to equity is 15. Dividend growth at a constant rate. The company has current market price of 64. Determine whether to buy more shares or to sell the shares. The company. So we are to determine either to buy or to sell. So we know the formula PO is equals to DO 1 plus G over R minus G. So does it have DO? Do you have a DO of the question? Yes, 5.4. So the DO is 5.4. G is equal to retention ratio divided with return on equity, which in kusema B times R. So what's our retention ratio? No, they are paying 60%, meaning they are retaining. I retain 40 for 0.4. Return on equity is 0.15. So how much will be our growth rate? So 15%, because we don't have any other. So return on equity, 15%. Itakuwa ni 0.06. Now let us find PO, which is 5.4, 1 plus 0.06 over. Now, because we don't have R, we use the return on equity as our rate in that case, because we don't have any other rate in that case. But come on, if now we use that one. Now the answer is 63 Kenya shillings. Kenya shillings 63.6 per share. Now let's compare this one. PO, our MPS is from the question 64.5. Now meaning our MPS is greater than our PO, meaning is it overvalued or undervalued? What did we say? So our market price is more than, so our market price is greater than the PO, meaning the security is overvalued. So meaning it is overvalued. Now, what do you advise this person? So this person should sell because the price is overvalued. So I will say possibly overvalued. So he should sell. We should sell since PO, since MPS is overvalued. Now, let us jump to another question. Let's go to this sitting August 2022, question 5C. August 2022, question 5C. August 2022, question number 5C. August 2022, question number 5C. So August 2022, question number 5C. So August 2022, number 5C. So August 2022, number 5C. So this one is non-constant, or we call the discounted growth rate, discounted dividend growth rate, or the non-constant. So open August 2022. August 2022, question number 5C. So after 2022, question number 5C. After 2022, question number 5C. And the question reads, Coke Ltd paid a dividend of 2.5 per share. The dividend is expected to grow at a constant rate of 15% per annum for the first year. Then the rate becomes 10% for the next 2 years. Then the dividend will grow at 5% in perpetuity for the other years. The required rate of return is 12%. Required the PO. Now this one you use the discounted dividend growth model and the Godot's model. So we shall use two items here. The discounted dividend model, which states that the value of a stock is determined from the future cash flow of all the dividend that will grow at a different rate. But remember those rates, we start by a dividend which is more stable. So the rate which is more stable going to the rate which are less stable until they become constant. So this is how you do it. So we come up with that particular table. Yes. Then we can compute expected dividends. Then the present value info factor, interest factor, complement 12%, then present value, then present value. That is all. So here, then that question, it is possible to do it without stress. So year 1 up to year 5. So we remember up to year 5 according to the question. Then from year 6 to perpetuity. Then from year 6 to perpetuity. So that one is all about it. So rather than Kwanza, just calculate to expected dividend. So 2.5. So the rate at the beginning, kinaanza na 0.15. So raised to 1. So how much would that be? Itakuwa ni 2.875. Then the same amount, 2.875. And year 2, 1 plus 0.15 raised to 1. Raised to 1, which itakuwa ni 3.30. Then 3.3, 1 plus 0.15 raised to 1. Itakuwa ngapi? Itakuwa 3.8. 3.8. Then 3.8, 1 plus 0.15 raised to 1. Now, sorry, from year 4, then our rate change from 0.15 in a change to what? From 0.15 in a change to 0.1. 0.1. Then the other will be equal to 4.6. Then 4.6 is equal to, it will be equal to 0.1. Then hapana, nimefanya makosa. So 2.1 year 1, 1.5, 1.5, 1.5 up to year 3. Then year 4. Then year 4 3.8. This is equal to 4.1. So nimefanya makosa hapa 4.1. Yeah, call it 4.2. 4.2. Then have a 4.2 plus 0.1 is to 1, which will be equal to 4.6. Now the last one, we shall make use of Godon's model. We shall make use of Godon's models. And how do we do it? So itakuwa ni the previous dividend 4.6, the growth rate from year 6 to perpetuity, which is 0.05, over the cost of capital, which is R, which is 12%, then divided by 0.05. 0.05. So how much would that be? 59. Now we need to convert this future dividends benefits to present value by doing what? By multiplying the discounting factor. So 12%, the first one is 0.8929. They are putting 0.7972. They are putting 0.7118. 0.6355. 0.5674. Now, this one is to bring from year 5 to present value. So unachukua year 5. So for you to put this one to present value from year 5, to be 0.567. Now this one, because tumerudisha from perpetuity to years to at the beginning of year 6, ni kumaanisha now we need now to convert it now from year, because tumetoka from the present, from the perpetuity to year 6. So to have to now from year 5 to present. How do you convert from year 5 to present? We use the same rate, 0.5674. Now we shall add zote together. Once you get that figure, we shall get the implicit value. We shall get the implicit value. So tunasema 2.875 times 0.8929. So that is 2.3. So 3.3 times 0.7972, 2.6. 3.8 times 0.7118, 2.7. 4.2 times 0.6355, 2.7. Then 4.6 times 0.5674, 2.6. Then 59 times 0.5674, 33.5. Let us add 2.3 plus 2.6 plus 2.7 plus 2.7 plus 2.6 plus 33.5. So 46.4. So Kenya shillings, 46.4 per share. That's the PO, or the intrinsic value. That's the PO or the intrinsic value, or the intrinsic value. So 59. Or the intrinsic value. So 4.6, let me confirm this one, 1.05 divided by 0.12 minus 0.05. Sorry, 4.6 into bracket 1 plus 0.05 divided by 0.12 minus 0.05. This one is 69. You got 59. This one is 69 times 0.5674, which is 39. 39.2. Now let us confirm this figure. So we add 39.2. So 52.1. So this one is 52.1. 52. So the market price is 52. So the market price is 52. The market price is 52. April 2022. April 2022. It will be our last question. April 2022, question number 1D. 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 So sitaki kuvuta hii kwa sababu nitavuta tu ndani. The purpose of feeding the figures. April 2022, question number 1D. So April 2022, number 1D. So I'm interested with the figure inside. I hope in a figure year 5, then from 6 to perpetuity, hopefully, but we shall see. And the 12% before the vote, let me read the question. So April 2022, question number 1D. So April 2022, question number 1D. So April 2022, question number 1D. So April 2022, question number 1D says that you are in attachment in an investing firm, and the following information regarding investment has been provided to you by the company whose earning per share, the difference in the current financial year is 8. So EPS is 8 shillings. The company adopts payout ratio of 60%. So meaning retention ratio is 40. The company considers it to investment number 1. The firm has an option opportunity which, if undertaken, the growth rate will be 10% per annum for the next 3 years. Then the growth rate will fall to 8% the next 2 years. Then in the next 2 years, then after 3 years, it will be stabilized to 6% per annum. Option 2 continues the current investment at a growth rate of, or dividend will continue at a rate of 10% in perpetuity, or required, assuming that the required of 16%, advise on the best option. So you are to advise on the best option. So this one will change because of 18%. This is the change. So this one will change because of 18%. Let us start with option 1. Let us start with option 1. Now we need to calculate the dividends. So we need to calculate the dividends. So we have the EPS as 8. So payout ratio is equal to DPS over EPS times 100 because it's in percentage. So the payout ratio mtembea ni ngapi? 60%, which is equal to DPS, which we want it, over 8 times 100. So what will be our DPS? It will be 8 times 60 over 100, which is Kenya shillings 4.8. That will be Kenya shillings 4.8, if I'm not wrong. So Kenya shillings 4.8 per share. So 4.8 per share. So tuanze na hii. So amesema ni 18% hapa. So we change it to 18%. So tunasema 4.8 into bracket 1 plus. Now the first year wamesema 10%, so which is 0.1 raised to 1. So mimi huwa nafanyanga raised to 1 ndio kwa rahisi. Kwa ni 5.28, then 5.28 naileta hapa 1 plus 0.1 raised to also 1 ndio kwa rahisi. 5.28 itakuwa ni 5. So mimi nataka hapa ni figure kubwa 805. Then 5.805 1 plus year 3, wanasema inafika year 3, so 0.1 still because inafika year 3. What will be the figure? 6.3888. Now from year 3 the growth rate will change. 1 plus 0.1 it will change to what? So it will change to 0. It will change to 8%, which is 0.008. 8%, 0.8 raised to 1, 6.900, then 6.900, 1 plus 0.086 itakuwa 8% raised to 1, raised to 1 itakuwa ngapi? 7.452. Now this dividend utatumia hapa chini. So hiyo dividend utaitumia hapa chini. Let's make use of it. So this dividend inakuja hapa 7.452. It will grow at this rate in perpetuity. So what is the rate for perpetuity? Umetuambia ngapi? The rate for perpetuity umetuambia ni 6%, which is 0.06 over our rate pale ni R 0.18 minus 0.06. So what will be the figure? The figure will be equal to 65. Nikiweka 0.826. Now let's go to our table and find these figures. Let's go to our table and find these figures. So for year one, 0.8475, 0.7182, 0.60, 86, 0.5158, 0.4371, then 0.4371. So itakuwa ni 4.4748, 4.1713, 3.8882, 3.5590, 3.2573, and then your motion is 28.7725. Now, when we add them together, we shall get our PO there as 48 shillings. So Kenya shillings, 48 per share. Now we start tomorrow from the valuation of preference shares and debenture. Then you do the relative measure, that is economic value added, and the market value added. So for today, that one is enough. We shall do more question tomorrow. Have a lovely night.